Hello class, today we're going to take a look at Chapter 3, Gross Income, Inclusions, and Exclusions. Learning Objective 1, when and how to record income for tax purposes. Income recognition for tax purposes, the income must be realized and earned, and this is similar to recognition for accounting purposes. However, we're going to have 3 additional conditions that need to be met. Economic benefit of the transaction, conclusion of the transaction, and income from the transaction must not be tax-exempt income. And we've got a concept check that's going to directly relate to this. First one here says an individual must recognize income on his or her tax return if the transaction meets 3 conditions. Name those 3 conditions. There needs to be an economic benefit. The transaction needs to have come to a conclusion, and it cannot be tax-exempt income. And later in the slide deck, we'll get a little bit more information on that. 2, an individual can exclude certain income from taxation even though a transaction that has economic benefit has occurred. And that's going to be true. That even though there might be economic benefit, if it hasn't come to a conclusion or if it's tax-exempt income, the individual can exclude it from income. Learning Objective 2, the cash method of accounting as it applies to income taxes. And now almost all individuals, when they file their tax returns, are going to use the cash receipts and disbursements method. An example of this might be to where if you were doing some landscaping services or something like that for summer and fall, but did not actually receive payment, didn't receive cash for that until January, then you would you would include that income those monies as income in the tax year in which you received the money. So the tax year that January was in, not the year in which the services actually were performed for the summer and fall. And this would include a constructive receipt. So if you perform those services in summer and fall, and then the individual who you perform the services for example, deposited that money in your account, even though you didn't physically receive any money from them, you have the right to control the income now that it's in your bank account, so that would count as receipt and trigger income recognition because you've received that property. So our second concept check here, the first one is income may be realized in any form, whether in money, property, or services, and that is true. So you could, instead of receiving money for the landscaping services, if you were a lawyer and provided legal services in return, then you would just use the value of those services as the income received. But both parties in that situation would report income recognition. So income may be realized in any form, and it doesn't have to be money. It can be property or services being provided as well. 2, if you provide consulting services to your friend and in exchange he fixes your car, you and your friend must report on both tax returns the fair market value of the services provided. Again, this is closely related to the first example we just touched on, but would nonetheless be true in this situation as well. Learning Objective 3, the taxability of components of gross income, interest, dividends, tax refunds, and Social Security benefits. So interest, as far as taxability for interest, if you receive interest on money that you have deposited at a bank, savings and loan, or credit union, and it's over de minimis amount, so say $20, the bank will file a 1099 INT, and that is going to be a taxable amount that would have to be included in income, and that you're going to have to pay taxes on that amount, and it's going to be reported to the IRS. So you would also have to list it as such so it matches what the bank is also reporting out. Now, interest earned on Series E or double E savings bonds are going to be taxable, but you get to elect whether you're going to be reporting gradually or on an annual basis, or whether you're going to be waiting and paying including the interest rather fully at maturity. And then some interest received is going to be considered was tax exempt. So if the debt is issued by a state or U.S. possession or subdivision, that's going to be something like maybe the state of Missouri or some other U.S. possession that we're going to have that might issue debt. So something like that might be if Puerto Rico issued debt. That would be tax exempt for federal purposes. So when you're reporting it, then you would not include that in income. Other types of interest that must be reported, we're going to have seller finance mortgages. So if you installment sales on receivables, imputed interest on loans that made below market value, and interest bonds sold between interest dates. So this is typically like if you're coming to an agreement to make a certain amount of payments for the sale of a house, for example, then even though you may say that there's no interest on this, these are just principal payments, that's not the way the government's going to look at it. The government will look at it in terms of what would be the fair market value of that loan and what would the interest be, and then you would have a portion of those payments that would be as if it were stated interest. And then you would be reporting that interest. If the amount's going to be if the amount is going to be more than $1,500, then you're going to have to use one of those schedules, specifically here Schedule B, to include with that 2-page Form 1040. So dividends, the taxability of dividends are going to be, dividends are going to be distributions made to shareholders, and they are going to be potentially taxable depending on, or have a tax amount associated with, depending on what your earnings threshold is. And we'll look at a little bit more on that on a future slide. But right now, we're just looking at the fact that they're going to be qualified dividends. They're going to be those made from earnings profits of a payer corporation, and they're going to be from domestic corporations or qualified foreign corporations. So basically what this is saying is if you invest in a company, if you own stock in a company, that company has an obligation to declare a dividend if they so choose to do so. There's no requirement that companies pay dividends. But if they're paying a dividend, they'll declare and say how much of a dividend they're going to pay. And then once they declare that, they've got a legal obligation to make that payment to you. That payment is going to be considered different than the interest earned on deposits in a bank. So it's going to have a different type of taxability. And under the recent Tax Cuts and Jobs Act of 2017, the tax rate for the amount those dividends are going to get taxed at changed. And there's a big paragraph here that's listed as a bullet. Essentially what it's going to be is most dividends are going to get taxed at a 15% tax rate. If you're under a certain threshold, and that's a few of the numbers listed at the top part of that paragraph, there's actually going to be 0% tax levied upon those dividends. And then if you're over an upper bound, if you're over a higher income, it will go from 15% to 20% is what those dividends will get paid at. And that was to put it in line with what those capital gains rates were going to be. But for including in gross income and what we're going to tax that dividend at, it's going to be 15% unless you unless you're making a lower amount of money. Here listed here for the specific amount. Then it's going to be 0%. If you're making over a specific amount of money, then it's going to be 20%. And then other types of dividends, something called a stock dividend, a stock split. And that is if you own shares of a stock and that company sends you another share of stock in the mail as what they would refer to as a dividend, that is not going to be usually a taxable event, so that would not be taxed. And then you're going to be reporting those dividends on that Schedule B form of the 1040 if the amount of the dividend is more than $1,500. So additionally, if you received a refund from your state or local governments typically are going to be Kansas City or St. Louis as the localities that have earnings taxes, or if you paid state tax, the refund is going to be taxable if you itemized in the previous year. And the reason why is because you can take the amount paid to that state government as a deduction, or state and local government as a deduction. So if you deducted it from the previous year's gross income, but you deducted more than you otherwise should have and received a refund this year, so you don't double dip, then you're going to have to add that back into this year's gross income. Social Security benefits. For the most part, most taxpayers are not taxed on their Social Security. However, part of the Social Security benefits may be taxable. And then we got to look at to determine if that's the case or not, something called provincial income, and that's also known as a modified adjusted gross income or modified AGI. And we're going to take a look at how that calculation is done. So the provincial income is going to be the AGI plus interest on U.S. bonds, excluded for education purposes, most tax-exempt interest, any adoption benefits that were provided by the employer, excluded foreign income, and then deducted interest on education loans, deducted tuition and fees, and then half of the Social Security benefits are going to get included with that provincial income. And then if it exceeds certain thresholds, and we'll take a look at those thresholds, then half of the Social Security benefit is going to be taxable. And then as the provincial income increases, the amount of taxable of that Social Security benefit is going to increase to as much as 85%. So if you are under the threshold, it may not be taxable. If you meet a certain threshold, 50%, and then up to 85% could be taxable. And here's those thresholds. For the lower amount, married filing jointly, it's going to be $32,000 with an upper amount of $44,000. And then for single head of household or qualifying widower for your filings, the lower amount is going to be $25,000 and the upper amount is going to be $34,000. So let's take a look at some examples to see this. So if Karen files, first of all, if Karen is a qualifying widower, she receives $7,000 of Social Security benefits, $19,000 of interest income, and $5,000 of non-taxable municipal bond. Her provincial income is going to be $27,500. And then we get that by $19,000 plus $5,000 is going to be $24,000 plus half of the $7,000, so $24,000 plus $3,500 to get $27,500. And she's going to report taxable Social Security benefit equal to the lesser 50% of that benefit, so that would be the $3,500, or 50% of the excess provincial income over that bound, over the $25,000. So that'd be $1,250. So her taxable benefits here are going to be $1,250. So other types of taxable income are going to be jury duty. If you go to jury duty, you'll get a stipend that usually pays for lunch and maybe some parking. That is technically going to be taxable income. If you win the lottery, prizes and awards are going to be taxable income. If debt is forgiven, if you owe, say, $10,000 of debt and it's written off, if let's say you had $10,000 of credit card debt and the credit card company said, we're not going to recover this, so don't worry about it, we're going to forgive your debt, then that's going to be considered $10,000 of gross income in the year in which they did it. So you would have to pay tax on it. And then insurance proceeds in excess of the adjusted basis of the property. So if you had a $100,000 house and received $120,000 of insurance for damage to it, that $20,000 difference that was above what the property was worth would be considered gross income. So let's take a look at a concept check here. Number one, all interest received from state and local bonds is not taxable. That's going to be false. And then two, a Schedule B is required if an individual receives $1,500 of interest for the taxable year. And that's going to be technically false. It's a little tricky here. It's going to be more than $1,500. That's what if an individual receives more than $1,500 of interest or more than $1,500 of dividends for the tax year, then the Schedule B. So $1,500, you do not need to file it. $1,501, you would need to file it or include it in the filing. Take a look at these concept checks. Qualified dividends arise from the earnings and profits of the payer corporation. That is true. A corporation can pay only cash dividends to its shareholders, and that is false. A corporation could also pay stock dividends, for example. So look at this concept check. Linda and Mason filed a joint return. Their AGI before Social Security was $22,000. Social Security benefits were $9,000. Tax-exempt interest was $1,250. What is the amount of provincial income? We're going to have $22,000 for the AGI plus half of the Social Security benefits, or half of the $4,500, and then we're going to add back the tax-exempt interest of $1,250. So the total will be $27,750. This concept check: name a type of income that is listed on line 8 of Schedule 1. That's going to be jury duty or gambling winnings. Objective 4, the rules concerning items excluded from gross income. Income excluded from gross income is going to be fringe benefits. It's going to be one example, and they qualify if they meet non-discrimination rules. An example of this might be no additional cost services provided to an employee. So if you are a flight attendant and there's an unused seat on your aircraft, you're allowed to fly on that or take a hop to wherever the destination of that airline is going, and you do not need to record the value of the air flight as gross income. Similarly, if you stay in, if you're a hotel employee working in the hospitality industry and you stay in one of the rooms that is unsold and otherwise would not be revenue for them, then you don't need to record the value of that hotel as in your gross income. So also discounts provided to employees for products or services normally sold by the business. In case of products, the discount cannot exceed the gross profit margin, so you can't essentially take a loss on those products. In the case of services, the maximum discount is going to be 20%. You're also going to have qualified transportation benefits, and then what's called de minimis benefits. So it's going to be if you receive like a holiday turkey or go out to a company picnic or something like that. So these are going to be additional things that the company's technically doing to provide you a value, but it's of such a small amount that it does not need to be included in that the gross income. And non-taxable fringe benefits with certain limitations. That's going to include life insurance premiums for coverage up to $50,000. So your employer can provide you a $50,000 life insurance policy, and that's not going to be considered the value of the premiums that they are paying for that coverage is not something you need to report in gross income. And then educational or dependent care assistance, and that's going to be $5,250 for the education and $5,000 for dependent care, and that's not going to be included. That can be excluded. And other non-taxable income, they're going to have requirements and limitations associated with them, but we're going to have scholarships and fellowships, and depending on the circumstances and what the monies are used for, a scholarship, for example, if a student received a scholarship and used it for tuition, often that scholarship can be excluded from gross income. Qualified tuition program withdrawals, so if you had money that was in one of these vehicles, saving for the tuition, then it's not going to be a taxable event to use it for that purpose. Life insurance proceeds are typically non-taxable. Gifts and inheritance are typically going to be non-taxable. So let me see, you look at what the thresholds are going to be, but generally, if you're under those thresholds, it's going to be a non-taxable for that. Compensation for sickness or injury. So if you were injured in a car accident and received compensation for that injury, typically you would not need to report the compensation earned in the lawsuit as taxable income. Child support payments and welfare are not, and then employee provided adopted assistance is not. So let's take a look at the concept checks here. Holiday turkeys given to employees are included in gross income. That is false. In general, scholarships are not taxable if the use of the money is to pay tuition, fees, books, supplies, and equipment. That is true. Learning objective 5, the rules associated with tax accounting for savings bond interest used for education expenses, below market interest loans, gifts, loans, and original issue debt. Discount debt. So savings bond interest is not taxable if it's used to pay for higher education expenses. And that's going to be for the taxpayer, the spouse, or the dependent children. And then the full exclusion is allowed if the education expenses exceed the redemption amount. So if you have a $10,000 savings bond, for example, and have $12,000 of qualified expenses, then you're not going to have the entirety of it. The entirety of it can be excluded. And then the limitation is going to apply if modified AGI exceeds $121,000 on joint return or $81,000 on other returns. So there's going to be a limitation there based on the AGI. So below market interest loans, that our instrument is created with interest rates that materially vary from the market rates, then interest is required to be imputed. Again, so this is something to where if you give a 0% interest loan, but the going rate or the fair market rate might be 5% for it, imputed interest is not going to apply if it's for a sale property of $3,000 or less, or all payments are due within 6 months. So you have a small value of the property kind of exclusion there from that, or a small duration, small time window exclusion. Other than that, you're going to have to look at what the fair market value of the interest rate would be. And then gift loans. So imputed interest would apply on all gift loans over $15,000, where foregone interest is in the form of a gift. So that's if you were to give someone $20,000, say, just pay me back the $20,000 when you get a chance. That is going to have imputed interest associated with that, with what the fair market rate would be. And then original issue, a discount is going to be equal to the difference between the acquisition price and the maturity value. So this is going to be to where if you go out for a loan and you're going to have to pay back, say, $100,000 in 10 years, but you don't receive $100,000 at day zero. So it's going to be similar to, if you remember back to financial accounting, issuing at a discount or issuing at a premium, to where that difference between what you have as proceeds when you issue the debt and what the maturity value is going to be how we're going into calculating that original issue discount. You have to report part of that original issue discount as income every year. And that is not going to be applicable, however, though, if it's for a tax-exempt debt, U.S. savings bond, debt with a maturity of a year or less, and then obligations prior to 1984, or business loans of $10,000 or less. Let's look at the concept check here. An individual is required to impute interest on a deferred payment contract where no interest or a low rate of interest is stated. That is true. Our second concept check, if someone purchases a debt instrument such as a bond from an issuer for an amount less than par value, the transaction creates original issue discount, or OID. And that is also true.